Let's start with a number that most financial commentators have completely ignored: $37 billion. That is the record-breaking amount that the world's central banks collectively spent acquiring gold in the first quarter of 2026 alone. Not over a year, not over a cycle, in one quarter. While retail investors were drawing bear flags on their charts and debating whether the pullback from recent highs represented a structural breakdown, the most sophisticated and patient capital on earth was doing something very different. It was buying, quietly, consistently, and in quantities that dwarf anything we have seen in the modern era of central bank gold accumulation. If you have been watching precious metals for any length of time, you know that price action alone rarely tells the full story. The chart shows you what has already happened. What matters, what truly determines the next major move, is what the largest, most informed, and most patient participants in global financial markets are doing with their balance sheets right now. And right now they are allocating to gold at a pace that should command the full attention of every serious investor, regardless of their current positioning. Gold is trading around $4,298 per ounce as of early May 2026. Silver is at approximately $75.90 per ounce. To some observers, these prices represent levels where consolidation and caution make sense, but when you put those prices in the context of $37 billion in institutional sovereign demand in a single quarter, alongside the structural forces I'm going to walk you through today, what looks like a pause begins to look like something else entirely. It begins to look like the kind of accumulation window that in retrospect becomes the most important entry point of a decade-long bull market. In my years of tracking sovereign capital flows, I have rarely seen such a massive divergence between what the public believes and what the actual money is doing. The public sees a market that has pulled back from highs and interprets that pullback through the lens of short-term price momentum. The institutional sovereign buyers see a structural repricing of the monetary system and are positioning accordingly. That divergence between perception and actual capital allocation is precisely where the most significant investment opportunities in history have been created. Let me explain why the current pullback from recent highs is not what many traders are treating it as. When a market corrects after a major advance, the natural human tendency is to project that correction forward and assume it signals the end of the underlying trend. This is the psychological trap that retail participants fall into repeatedly, and it is the psychological advantage that patient institutional capital exploits repeatedly. A correction within a long-term structural bull market is not a failure of the thesis. It is the mechanism through which the bull market refreshes itself, shakes out weak hands, and creates the conditions for the next leg higher. The structural bull market in gold has a foundation that goes far deeper than technical chart patterns. It has roots in monetary policy, geopolitical fragmentation, de-dollarization trends, fiscal deficit dynamics, and the progressive erosion of confidence in paper currency systems. None of those forces have reversed because the gold price pulled back from a recent peak. If anything, they have intensified. And the $37 billion in central bank purchases during Q1 2026 is the single most powerful piece of evidence that the institutions with the most direct visibility into these structural forces continue to act on them. Now let us talk about the dollar, because understanding the relationship between the USD index and precious metals is central to understanding where we are in this cycle. The DXY, the dollar index that measures the greenback against a basket of major currencies, has been testing and at times breaking below the 96 level. That threshold matters enormously. For most of the post-pandemic monetary cycle, a dollar index above 100 provided a structural headwind for dollar-denominated commodity prices. As the dollar has weakened toward and through that 96 level, the mechanics that suppressed precious metals pricing for years have been reversing. The dollar's weakness is not accidental. It is the product of fiscal realities that the United States government faces, regardless of political administration. The U.S. deficit trajectory requires financing at a scale that, when combined with global reserve diversification away from U.S. Treasury holdings, puts sustained downward pressure on the dollar's relative value. Central banks that were once the most reliable buyers of U.S. government debt have become net sellers or have dramatically reduced their purchases. That capital has to go somewhere. Increasingly, it is going into gold. The inverse relationship between the dollar and precious metals is not a coincidence or a temporary correlation. It is a fundamental reflection of the global monetary system's architecture, and that architecture is shifting in ways that favor hard assets. There was a period in late January and early February 2026 when the dollar experienced a brief, sharp rally that many interpreted as a reversal of the underlying trend. Market participants who watched these dynamics closely noted that the timing and magnitude of that move had characteristics consistent with coordinated intervention rather than organic market dynamics. Whether that interpretation is correct or not, The subsequent price action told the story that matters. The dollar's rally was not sustained. The 96 level reasserted itself as resistance, and precious metals resumed their underlying bid. When powerful institutional forces attempt to manage currency dynamics against the underlying structural current, the market eventually prevails. The structural current here is flowing against dollar strength and toward hard asset appreciation. I often tell my subscribers that the chart tells you where we have been, but the central bank balance sheet tells you where we are going. This is not a metaphor. It is a literal description of how macro analysis works at the highest level. When you aggregate the balance sheet activity of the world's largest central banks, the People's Bank of China, the Reserve Bank of India, the central banks of Turkey, Poland, Hungary, the Gulf states, and dozens of others, you see a coordinated, sustained, multi-year movement toward gold as a reserve asset. That movement did not begin in 2026, and it will not end because of a quarterly price correction. It is a generational realignment of how sovereign wealth is stored and protected. The People's Bank of China has been particularly significant in this context. China's official gold reserves, while almost certainly understated relative to actual holdings, have increased consistently over recent years. More importantly, China's broader strategy of reducing dollar dependency in trade and reserve management creates a structural demand floor for gold that is independent of Western investment sentiment. When the world's second-largest economy is systematically reducing its exposure to dollar-denominated assets and systematically increasing its exposure to physical gold, that is not a trade. That is a policy decision with a multi-decade time horizon. Let us now address an argument that has circulated in financial media about the Federal Reserve and what recent policy deliberations signal for the monetary environment. There has been discussion about dissenting votes within recent Fed policy meetings, with some commentators suggesting this signals a committee more likely to move toward tightening than the consensus assumes. I want to be precise here, because precision matters when this kind of analysis influences investment positioning. The dissenting voices within the Fed's recent deliberations appear to reflect disagreements about the pace and communication of potential easing, not a structural shift toward tighter monetary policy. The Fed faces a deeply uncomfortable set of constraints: inflation that remains above target by any honest measure, a labor market showing early signs of softening, a fiscal deficit that requires accommodative financial conditions to be manageable, and a global environment in which aggressive tightening would create dollar dynamics that create their own set of problems. My personal analysis of the upcoming Fed leadership transition suggests we are moving toward a period of aggressive easing that the market has yet to fully price in. The institutional framework within which the next Fed leadership will operate is one of constrained choices. They will face pressure from fiscal dynamics, pressure from employment dynamics, and the structural reality that the US economy has become highly sensitive to interest rate levels after years of ultra-low rate conditioning. In that environment, the path of least resistance is easing. And easing, in the current inflationary context, means negative real interest rates, which is historically the single most powerful environment for precious metals appreciation. The concept of real interest rates deserves careful examination because it is genuinely central to understanding why gold at $4,598 and silver at $7,590 may represent only an intermediate point in a much larger repricing. The nominal yield on US Treasury securities has been in the range of approximately 3.7% for intermediate duration instruments. That number sounds reasonable in isolation, but the question that matters for gold is not what the nominal yield is. The question is what that yield delivers in terms of real purchasing power preservation after accounting for the true rate of monetary erosion. Official inflation measures, including the Consumer Price Index, are constructed with methodological choices that consistently understate the inflation experienced by actual households. If you look at housing costs, insurance costs, healthcare costs, and food costs, the core categories that dominate actual household budgets, the rate of monetary erosion that most people actually experience is significantly higher than the headline CPI suggests. At a 3.7% nominal yield and a real-world cost of living increase that many analysts and market participants estimate at 5 to 7% or higher, the real return on holding dollars in Treasury instruments is deeply negative. That is the environment in which gold functions not as a speculative asset, but as a rational choice for capital preservation. The energy dimension of this picture deserves attention as well. Major oil producers and energy companies have been communicating forward guidance on oil prices that, if accurate, would add sustained inflationary pressure to the global economy for the foreseeable future. When energy costs are elevated and persistent, they create second-round inflationary effects throughout every supply chain in the global economy. Transportation costs, manufacturing costs, agricultural costs, all of them carry an energy component, and elevated energy prices prevent the kind of broad disinflation that would allow central banks to normalize monetary policy without causing significant economic damage. For precious metals, this dynamic reinforces the negative real rates thesis and extends the window in which gold and silver serve as meaningful hedges against monetary erosion. When I look at the current Polish and European silver premiums, I see the same physical tightness that preceded the historic 2025 breakout. Silver premiums, the spread between the spot price and the actual price paid for physical metal in the form of coins, rounds, and small bars, are a signal that the paper price is not fully reflecting the physical market reality. When physical silver is trading at a meaningful premium to spot, it tells you that immediate physical demand exceeds immediately available physical supply at the spot price level. That condition does not exist in normal market environments. It exists when physical demand has an urgency that paper trading does not capture. European and Polish dealers reporting elevated premiums on silver is consistent with a global picture of physical silver accumulating structural demand pressures. Silver's case in this market environment is multidimensional in a way that gold's is not. Gold is primarily a monetary metal. Its price is driven by monetary policy, currency dynamics, and reserve management decisions. Silver shares those monetary characteristics but adds to them an industrial demand profile that is growing at a pace driven by some of the most powerful structural trends in the modern economy. Solar energy, defense electronics, medical devices, electric vehicle systems, 5G infrastructure. These applications require physical silver in quantities that have contractual stability built into them. Long-term manufacturing contracts and infrastructure development programs create a baseline of silver demand that is not price-sensitive in the short term. Even if investment demand for silver were to pause completely, the industrial demand floor would remain intact and growing. The math of silver's industrial demand creates a situation where the metal has a meaningful price floor that gold does not have in the same structural way. When you combine that industrial demand floor with silver's monetary characteristics and its historical tendency to outperform gold during the later stages of precious metals bull markets, the case for silver as both a hedge and an appreciation asset becomes compelling in the current environment. Let us talk about what the data is actually telling us about institutional conviction in precious metals, using a framing that I find clarifies thinking when the noise level gets high. The way to measure real institutional conviction is not through price movement. Price can be moved by many things, including short-term speculation and technical trading. The way to measure real institutional conviction is through what I call the dollar commitment signal, the total dollar value of capital being allocated to an asset, adjusted for any changes in the number of units being purchased. Here is why that distinction matters. Central bank gold purchases in Q1 2026 amounted to $37 billion. If we compare that to the volume of gold actually purchased in metric tons, we find something that reveals the depth of institutional conviction. At current prices, $37 billion buys fewer metric tons of gold than the same dollar amount would have bought 2 or 3 years ago when prices were significantly lower. Yet central banks are still spending at record levels. What that tells you is that the price increase has not deterred the buyers. They are not price sensitive in the way that retail investors are. They are committing capital in dollar terms at record levels regardless of the price per ounce. That is the definition of conviction buying. That is what accumulation looks like when the buyer has a long time horizon and a structural thesis that does not depend on quarterly price performance. This is the fundamental difference between how institutional sovereign capital approaches gold and how retail investors approach it. A retail investor sees the price go up and worries about buying at the top. A central bank sees the price go up and interprets it as confirmation that their thesis about monetary debasement and dollar dynamics is correct. They buy more because the thesis is being validated, not less because the price is higher. Understanding that behavioral difference is key to understanding why central bank demand data is such a powerful leading indicator for the precious metals market over multi-year time horizons. Having survived multiple market cycles, my intuition, backed by this $37 billion data point, tells me that we are currently standing at the most important inflection point of the decade. I use the word inflection carefully because it is not a word that should be applied to every market development. An inflection point is a moment where the underlying trajectory of a long-term trend becomes clear in retrospect, even if it is contested in real time. The accumulation of structural evidence, central bank buying at record dollar values, dollar index weakness, negative real rates, physical market tightness in silver, industrial demand growth for silver, and geopolitical fragmentation driving de-dollarization, represents a convergence of forces that, taken together, point toward a sustained period of precious metals outperformance. The price targets that serious macro analysts have been discussing, $7,000 gold and $150 to $200 silver, are not arbitrary numbers pulled from optimistic projections. They are the output of models that account for historical monetary cycles, current dollar debasement trajectories, and the supply-demand dynamics of both metals in a world where physical availability is increasingly constrained relative to financial claims. These are not guaranteed outcomes. No investment outcome is guaranteed. But they represent logical destination points if the structural forces currently in motion continue on their present trajectory, which the central bank data strongly suggests they will. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, remains elevated relative to historical norms. At current prices, gold near $4,598 and silver near $7,590, the ratio is approximately 60 to 1. Historically, when precious metals bull markets reach their later, more explosive phases, this ratio tends to compress significantly, sometimes reaching 30 to 1 or lower. A compression of the ratio from current levels toward historical norms against a backdrop of rising gold prices implies silver price appreciation that would substantially exceed gold's percentage gains. The combination of monetary and industrial demand, constrained physical supply, and the ratio compression dynamic is why many analysts who follow both metals consider silver the higher conviction opportunity from current levels, even though gold commands more media attention. Before I close today, I want to address something directly because I think it is important for anyone making allocation decisions in this environment. The question of position sizing in precious metals is one that deserves honest treatment. Precious metals are not stable stores of value in the short term. They are volatile assets that can experience significant drawdowns within longer-term bull markets. The right position size for any individual depends on their overall financial situation, time horizon, existing portfolio composition, and personal risk tolerance. What I am presenting here is a macro framework and an analysis of structural forces. It is not financial advice, and nothing in this analysis should be treated as a recommendation for any specific action. What I would encourage you to consider is the following. When you evaluate your exposure to precious metals, are you primarily tracking the price ticker and making decisions based on short-term price movements? Or are you tracking the dollar commitment signal, the actual dollar value of capital being allocated to these assets by the most informed institutional participants in the world? Because those two approaches will lead you to very different conclusions about what the current moment represents. The price ticker will tell you that gold has pulled back from recent highs and that volatility makes this a difficult environment to hold positions through. The dollar commitment signal, $37 billion in Q1 2026 alone, will tell you that the institutions with the most direct visibility into monetary system dynamics are allocating to gold at record levels with no sign of abatement. Those are two very different stories, and only one of them is consistent with the $37 billion data point. I want to hear from you in the comments. What is your current positioning in precious metals? Are you tracking the physical premium data in your local market, and are those premiums consistent with what you would expect in a functioning paper market? Or do you see evidence of the same physical tightness that the European data is beginning to suggest? Are you sizing your positions based on the price chart or based on the dollar commitment signal from central banks? And perhaps most importantly, what would it take to shift your conviction level on this macro thesis, either higher or lower? The structural forces driving this market have been building for years. The central bank data from Q1 2026 suggests they are not abating. The physical market dynamics suggest the paper and physical markets are diverging in ways that historically precede significant repricing events. The macro environment of negative real rates, fiscal deficits, and dollar weakness creates the monetary conditions that have consistently favored hard assets over paper claims throughout financial history. All of these forces are converging right now, and the world's most powerful financial institutions are voting with $37 billion worth of conviction that they know where this leads. The question is whether you are watching the ticker or reading the balance sheet.